CPI print yesterday coming in hotter than expected. That clearly spooked the markets. We're seeing some relief here ahead of today's open. Here to break it all down, we want to bring in Stephanie Roth, Wolfe Research, a chief economist. Stephanie, it's great to have you here on set. So at least it looks like in terms of the market's reaction, there is a little bit of relief here today. Do you think that's the right read on that? Why or why not?
Definitely. So when you look at the data, now we're tracking core PC somewhere around 0.24, 0.25, which is very different from the message we got yesterday with core CPI coming in at 0.36%. So now we're tracking a lot better in terms of PCE, which is what the Fed really cares about. Some of the details within the print, especially on the services side, were kind of favorable. So motor vehicle insurance was the story yesterday. That's what popped. That drove a 6 basis point acceleration in core CPI. That came in much more modestly in today's print, came in 0.6%, and that's what feeds into PCE. So, yeah.
Yeah, and so a lot of questions with regard to this as to what additional levers the Fed can pull right now to get this closer to their targets as well on inflation.
Yeah, I mean, June's just a little bit too soon for them to be cutting rates. So we're now looking more like July. The market has certainly priced that in. Today's data is not soft enough to change that narrative by any means, but it is a little bit more a positive signal in terms of at least getting a little bit more progress on that front. It's not going to be convincing enough by June, but by July, we think there's a decent chance that the Fed could actually be cutting.
So did you change your base case as a result of yesterday's print?
We did. So we were looking for 3 cuts starting in June. We had been admittedly, questioning whether June was enough time to really convince the Fed. And yesterday's print was enough to take us over the edge and push us to July.
Stephanie, some were out there on the street yesterday saying, some Wall Street pros were saying that, hey, actually yesterday's print wasn't that bad. They were highlighting some key areas of improvement when it comes to the inflation print there. That silver lining read on yesterday's print, at least, is that realistic at all or no?
I mean, I have to say that was my read of it too, to some extent. When you look at your Bloomberg screen, it doesn't look great, right? You had a beat. The Fed can't really deal with any more beats to some extent and be able to cut in June. That said, when you look in the details, you had deflation in terms of goods prices, which was something people were worried about in February because you started to see a little bit of a tick up in goods. People were wondering if this was going to be a trend. It's not. And then on the service side, a lot of it was driven by things like motor vehicle insurance. And it appears to be a bit of an aberration. My sense is that it will probably reverse in the coming months. And that took core CPI up from, it would have been 0.3 to 0.36.
And so in the areas that we did see decreases in indexes within the CPI report as well, where consumers are clearly pushing back on what prices that they are paying, where then are we starting to see cracks within this broader consumer resiliency story as well?
To be honest, the consumer resiliency story is still in play. The consumer is still fairly resilient. I would say on the good side is probably where you're starting to see a little bit of softness. Sure. That's what was particularly strong in the back half of last year, almost surprisingly so. So now you're getting a bit of a reversal on the good side, and services spending is starting to pick up a little bit. And our base case is you'll have fairly steady consumption this year. And the sort of the incremental driver of growth from this year compared to last year is going to be on the manufacturing side.
When it comes to the risk of recession, if we see no cuts this year, obviously a lot of that would point to the fact that we are seeing resiliency in the economy. Labor has held up much better than expected. Inflation print still running a bit hotter than what the Fed would like there, so a bit of a concern. But in terms of if we don't see a cut this year, if we're looking into 2025 for that first cut, does that at all change the calculus in terms of that rising risk of recession?
I mean, the Fed is incredibly data dependent, and to the extent that they start to see cracks, they're going to be very willing to cut. Inflation is not high enough such that if they start to see problems in the labor market, they would hold off on cuts, which is different from where we were a year and a half ago. Back then, inflation was truly running so high, even if we started to see cracks, there was nothing they could really do. Now the dynamics have changed in a big way, which is why recession risks have come down pretty notably. Even if the timing gets pushed from July to December, that doesn't really change the overall story.
I know that you're an economist, but I mean, as we think about the earnings season here as well, and how companies may define the broader kind of macroeconomic equation that they're wading through as well, what do you expect to hear from some of those biggest leaders in the way that they should or could be defining it?
Yeah, I mean, we expect to see that margins should continue to be pretty steady. That's been the case for quite some time, which is one reason why we haven't gotten these big layoffs that people had been anticipating. If company margins are elevated, why would they do layoffs? It's been so hard to hire people in this environment. So we continue to see, continued narrative around that. Consumer demand continues to be fairly strong. And then the potential incremental will be on areas like housing and manufacturing sector starting to bottom, and expectations looking ahead could be fairly positive.
All right, we got some layoff announcements to start the year, but perhaps the fact that it's not rolling layoffs that we're seeing continue to move forward, that a good sign here. Stephanie, thanks so much for taking the time with us. Stephanie Roth, Wolfe Research Chief Economist, kicking off today's show with us in studio.